and special welcome to Zach George, CEO of SNDL Inc. Zach, welcome.
Thank you, Pablo. This is actually my first ever appearance on Spaces, so thanks so much for having me.
All right, yeah, and I think that so far things are going smoothly on the tech side, although Twitter X is somewhat unpredictable sometimes. Look, let's just start on a personal note. Just brief, your career background, how you came to cannabis, and specifically, of course, how you came to SNDL. Thanks.
Thank you, Pablo. So without putting you to sleep, my background, I'm originally from Texas. I was born in Houston. I grew up in the UK, and I am a dual citizen of both the US and Canada. I graduated from Simon Fraser University in Vancouver, and shortly after headed to law school in New York. Passed the New York bar and never practiced, was originally trained as a credit analyst, and then spent almost 2 decades in the alternative investment space, mainly focused on event-driven and activist investing opportunities. I served on about a dozen public company boards and became a student of restructurings and turnarounds. And when it comes to cannabis, I was asked by some friends that were running a boutique investment advisory business in Toronto to look at joining the board of SNDL, and this was late 2019, which was experiencing difficulties and was then named the CEO about 2 months after joining as a director. So February of 2020 would have been my first month as CEO. So in terms of cannabis, I've been a casual consumer for some time, and I witnessed the medicinal benefits firsthand, as my father was actually prescribed cannabis oils when he was being treated for leukemia before passing in 2017.
Sorry to hear about that. And then you joined SNDL soon after that.
That's right. Joined as a director at the very end of 2019 and became the CEO in Q1 of 2020.
All right. Thank you, Zach. So look, we have a lot to cover, and obviously we want to touch on all the divisions of SNDL, particularly the Sunstream USA piece, right, which we see as a significant catalyst, but obviously you have a number of catalysts across your portfolio of businesses. But let's just do some recent history. If we go back, to the heady days of late 2020, early 2021, remind us of the funds that you were able to raise and describe how you've made use of those funds since then.
Absolutely. So just trying to paint a picture here again, my CEO journey started in early 2020. I think it would be helpful to construct a picture of what I actually stepped into. At that time, SNDL faced multiple class action lawsuits. It was burning cash aggressively, and its covenant breaches forced the company into the purview of the special loans groups at ATB and BMO, who were pushing us towards CCAA. And to put this in perspective, only about 4% of borrowers who go into special loans ever survive and exit, which made this a significant achievement for us later in 2020. By the middle of that year, we had found a concurrent set of solutions to restructure the business, including the sale of Bridge Farm, which was the largest glass house in the United Kingdom, a large debt for equity swap, and a very expensive rescue financing that would ensure we could continue to operate into 2021. Then in late 2020 and into 2021, SNDL became a meme stock, for lack of a better term, which is coincidentally resurfaced in the last few days. Mm-hmm. But there were 3 days during that period where we were actually the highest volume traded name on NASDAQ, with the largest day seeing over 3 billion shares trade in a single day. And because the company had been poorly positioned and only narrowly escaped CCAA in Canada, we knew that we had to drive change and that a hard reset was required for the business. So we were able to take advantage of the extreme volumes and the meme dynamic through a series of private placements and the usage of our ATM. And in doing so, we raised about 1.2 billion Canadian, and we're able to pay down all of our debt, which had peaked at almost $250 million, and then really lifted our heads up and asked the question of where economic returns could be found within the cannabis industry. And it was clear that in the more mature markets, particularly in the US, that the vertically integrated models were and they would typically be in limited license states, were more profitable, and that the financing of cannabis businesses was in many cases far more profitable than actually cultivating or selling cannabis. So based on these observations, I had pitched our board on a two-pillared strategy, with the first pillar focused on a vertical operation in Canada, and the second on building an investment business that could take advantage of the industry's very high cost of capital. So in terms of the deployment of that capital, Pablo, we closed the acquisition, and this was sort of our first step towards a vertically integrated model. We closed the acquisition of a retailer called Spirit Leaf in July of 2021. That was approximately $130 million acquisition at the time. Alcanna was acquired in March of 2022, and that was what really gained our exposure to liquor distribution, and also came with a stake in Nova, which at the time was a very disruptive discount retailer of cannabis in Canada. That transaction was about $320 million. And then in January of 2023, we closed on the acquisition of Valance, which was, again, a transaction with consideration just over $130 million Canadian in stock. Beside those operating transactions that were Canadian-based, we formed Sunstream, which is a joint venture in early 2021, and we have deployed more than $600 million Canadian into U.S. cannabis credits through that joint venture since then. Our core strategy is to win within the Canadian regulated products marketplace and use our experience to build a leading global cannabis company.
So look, there's a couple of things that I want to touch on. I mean, in terms of that liquidity, obviously back then in 2021, as you said, you were one of the most liquid stocks in the space, and there's significant value to having that liquidity, right? We see some of MSOs, trading $4 or $5 million a day at best, 2 or 3. Most of them trade well below 1 million. But more recently, I was looking at the last 30 days, Canopy Growth trading about 190 million on average last 30 days, Tilray Aurora about 87, and SNDL only about 19 million. So what can you do to, and I think, I double check these numbers, of course. So what can you do on your side to help the liquidity get back to, to the higher levels of the Canadian group? Any quick thoughts on that before we move on?
It's a great question. And I'm sure this wouldn't surprise you, Pablo, but we're spending a lot of time focused on our operations and focused on building a growing and profitable business. Not spending a lot of time worried about trading liquidity. Right. I know that the short interest and algorithmic trading can be at times an obsession with our retail base. Mm-hmm. That's not something we spend a lot of time sort of navel gazing on. We have our work cut out for us. We're making a lot of product in the business. We see a lot of opportunity. When you look at the comparable trading liquidity, I think that we've gone through in the last month a very prolific period. You mentioned Canopy, for example. They actually had recently a day where over $1 billion traded in a single day. So those numbers are slightly skewed by improvement in that activity, and we've caught some of that where I believe our sort of average volumes are sitting at around 6 million shares a day. But when you look at our current capital structure today, we certainly have access to both equity and credit capital. We have a debt-free balance sheet. We have sufficient liquidity and for our size, a reasonably large unrestricted cash balance. And so, I think getting to reach our growth objectives will broaden out our investor base ultimately and create significant equity value, which may in the future drive greater liquidity. But there's also a flip side to that, where if you saw even just half a dozen institutions start to take material positions, that could actually reduce liquidity in the stock, theoretically, right? So again, not something we can control, and we're heavily focused on the controllables.
Yeah, no, understood. Look, and I'm going to make, also in the same context of this conversation specifically, I'm going to make a comment, and I'd like to hear your thoughts here. After you raised capital in early 2021, you have not raised capital again, obviously. I mean, you've issued stock for some of the acquisitions like Valance and Alcana, I believe. But for the most part, in a context that most of the Canadian LPs have been forced to dilute their shareholders, your dilution has been minimal other than a couple of acquisitions, right? So in that sense, that's something that maybe gets lost in the discussion here that people should be paying attention to. Any thoughts on that?
It's a great point. We've repeatedly made sure that our quarterly press releases mention that we have not raised cash through equity offerings since July of 2021. We believe in earning the right to take risk. We believe that the disciplined deployment of capital is one of the best ways that we can earn the trust of our investors in the marketplace. And so we are really focused on intelligent and disciplined deployment of our existing cash balances. And we are also expecting that capital base or that unrestricted cash to actually grow with some of the credit exposure we have amortizing or being monetized back to us over the next 12 to 24 months.
Right, understood. And in the space has been maybe some questionable acquisitions by some players here and there. But just before we move on, maybe brief rationale of the acquisitions you've made, Valance and the Alcana, just brief rationale of the deals you've made on the M&A side.
Absolutely. And look, just as a preface here, and we're commercial partners with most of the top operators, both upstream and downstream in Canada. So those commercial relationships are really critical to us, whether it's on a B2B basis or whether we are distributors of their brands and products. So I don't want to overstate this or sort of spike the football, but I would ask the question, when you look across the landscape and you look at some of the acquisitions that have occurred in the space, who has more to show for their M&A activity at the end of the day? And I think when you look at the last 3 years for us, where clearly most of our revenue growth, which as of year end, our compound annual growth rate of revenue was over 120%. That has come largely through acquisitions. But this isn't a case where we acquired market share, which then collapsed on us, so to speak. These are real operating businesses. Clearly in Canada right now, retail is a great place to be. It's garnering superior economics relative to where upstream operators are sitting. That will likely evolve and change over time. But really the progression for us on M&A is a function of that commitment to a strategy on building a compliant vertical model. And so you saw us acquire retail. The other challenge we faced is with a NASDAQ listed entity that's operating in the cannabis space. We face really aggressive costs when it comes to everything from D&O insurance to Sarbanes-Oxley compliance. And so it was just never going to be the case that a model like this could be successful with us just being a craft grower of high quality cannabis. We needed scale. And so the Alcana transaction was particularly interesting in that regard, because not only did we acquire scale with a business that's generating about $600 million in revenue, but we also got a very experienced team with multiple decades of experience distributing regulated products. As you're well aware, the same regulators in these provinces are regulating, for the most part, both cannabis and liquor. And so there were relationships that came with that, retail IQ and experience that came with that, and also scale, which was important to our model.
Understood. Look, let's just move on to the valuation argument. I don't think you had this slide in your latest, in the first quarter investor deck, but you had it before, where you made this sum of the parts analysis and you show, how attractive the valuation of SNDL is. Can you expand on that here for the listeners? Thanks.
Absolutely. And this was a slide that was quite important to me, and I think it's a good illustration of where we sit today, and it's a good reference point for valuation, whether you think the stock's cheap or expensive. And we did include it. Actually, this time we actually put out 2 investor decks. There's a shorter deck, which I think you're referring to, which is which is more of a tool for analysts, and we actually walk through that in the call. But we have a larger deck that goes into some more depth, and the sum of the parts analysis is contained in that larger deck. So just trying to evolve our presentation materials and think of new ways to be transparent with our investors. But I would suggest that the sum of the parts analysis really it does need to be done on an enterprise value basis, and I'll kind of walk through this at a high level. And just to remind you, this, I'll do so in our reporting currency, which is Canadian dollars. So on a CAD dollar basis, we have a market cap today of approximately 885 million. We have no debt and unrestricted cash of approximately 190 million, which would reflect an enterprise value of about 695 million. We just provided a quarter-end Sunstream portfolio valuation at about $560 million CAD, which suggests that our operating businesses in Canada that are generating a run rate revenue of north of 900 million are worth no more than about 135 million. And that includes award-winning retail banners in a retail network with more than 360 brick and mortar doors, as well as significant real assets oriented towards cultivation and processing. So we believe that our valuation today is not demanding in any regard. We're still trading at about 75% of book value, which in US dollar terms, that's the only time I'm going to reference US dollars, but on US dollar terms at Q1, our book value stood at about $3.35 approximately per share versus today's stock at around $2.50. So you can use peer multiples to look at values for these assets, or look at a simple measure like book value. But I think the point is, even though our stock is up more than 80% in the last 3 months, we're still trading at, you'd still need to see another 30-35% move up to reach book value, which I think is significant.
Of course. And then just on that point, the 560 valuation for Sunstream, is that like the book value of the loans there, or how do you get to that 560?
That's correct. So you'll see an equity investees line item on the balance sheet. That's effectively a portfolio valuation. We don't consolidate the results of the borrowers, obviously, which would be highly problematic from a regulatory and NASDAQ standpoint. But that is a fluid measure. And so we've actually written that loan book down over time, accounting for multiple factors, including the dramatic change in the rate environment since 2021, but also in certain cases, the deterioration of credit quality where needed. So we've written that book down by just over $130 million over time. And we even have some of our performing loans that we expect to be paid back in full, marked in that NAV below par. And so maybe worth noting that any upward revisions to this NAV over time, whether that's due to, say, a change in the rate environment or a change in the state operating environment, would have a direct impact on our reported book value. And that would be the same case, whether it's up or down.
Understood.
Pablo.
Hi, Zach. Sorry, apologies for that. So let's just move on here, the discussion. I was just asking the question, and again, apologies to the listeners, and thank you for rejoining. I was going back to the meme issue, right? It's a bit of a blessing and a curse, right? You had the stock up significantly yesterday. The volatility may be an issue. How do you think about that, and how do you deal with that, if in any way? And then we'll move on. Just a brief answer on that.
Yeah, look, it's a great question. I think that we've really shown how we think about that when you dial back and look at our approach that was taken the first time around. So, there's no question that the dynamic that occurred in late 2020 and 21 was a material driver for our ability to build the business we have today. you must take a view on the valuation of the company. The company is not the stock, etc. We don't believe in growth for the sake of growth. We believe in protecting the per share value of the company. But in the event that we start to see, I mean, just compare it to the last time around, for a cup of coffee, the company was worth $6 billion. So if we see an outrageous valuation for a company that had never earned a single dollar of net income or free cash flow, are we going to take advantage of that and issue equity? You know, you don't just have to ask it. We did it, and we would probably do it again. I think this is different this time around. Mm-hmm. And what I would say is that when you look at some of the valuations in the space, and I don't want to get into specific names or you know, be critical, but I actually prefer our position. Again, so we've moved up more than 80% over the last 3 months, and we're still trading below book value. So I think we're in a good position. If we were standing on a precipice where we were subject to extreme volatility with an unsustainable valuation, it may be a great ride for, you know, certain traders, but not necessarily great for long-term investors or the company itself. So I think our posture and positioning is very attractive amidst this. And again, we're focused on the fundamentals and being best-in-class operators, not you know, benefiting from potential windfalls.
All right, thank you, Zach. So look, we're going to move on now and touch on the 4 divisions. And I don't want to put words in your mouth, but you know, we think about 4 pieces, right? Liquor retail, cannabis retail, the cannabis operation itself, and then the Sunstream backcourt, particularly in terms of the U.S. opportunity. It seems to me of those 4, the U.S. opportunity is the biggest, but please correct me if I'm wrong. I think that's where the investor attention is, and we want to touch on all 4 of them. But am I missing something when I say that the bigger opportunity is there, and then perhaps on Canadian rec and international, less so in retail, in liquor, and cannabis retail, I guess, very competitive. But again, your thoughts in terms of a portfolio there, and then we'll delve specifically into each piece. Thanks.
Thanks, Pablo. I think that's absolutely correct. And I think that's a consensus view, you know, largely driven by the size of that opportunity, the total addressable market, scale within individual states, and the sort of the wave of regulatory reform that's sweeping the U.S. and other international markets. So when we look at priorities in terms of capital deployment, I would say that the 2 standout opportunities we really see today are within you know, Canadian retail on the cannabis side, and then also deployment of capital into the U.S. So I think that's absolutely a fair comment.
Okay, understood. And let's just start on the U.S. right away, right? So maybe I know you cannot talk specifically about the operations of Sky Mint and Parallel, but just some general thoughts about what's inside that portfolio that you can share with us.
Yeah, absolutely. So the portfolio has been somewhat static after a period of quite rapid growth in the initial 12 to 24 months. We have 5 credits today. We've exited 2. So today you'll see exposure to Ascend, Jushi, Cannabis, and then also Sky Mint and Parallel, with those last 2 names in the midst of restructurings, which we anticipate will be completed later in this year.
Right, understood. And then just to be clear, and again, I realize there's only so much you can say given litigation and issues that are ongoing, but based on on your disclosure and your slides, when you put the total revenues of SNDL plus Sunstream USA, I think you've made the argument that you're like a number 4, number 5 MSO. If I try to, you know, subtract the SNDL piece, we are talking about, like, I think around $270 million in sales for the U.S. operation. Does that sound about right? And of course, if that's a number, it's significant, right? That's the size of Jushi and the size of other mid-tier MSOs. But some color that you could give there would help.
Yeah, I think that's a good synopsis. But in terms of that revenue base, I'd say that's really just attached to the companies going through reorganization today, and would exclude the performing credits at this time.
Okay, understood. And look, I'm going to stay on this piece and again, answer only what you can. But in the case of Parallel, it's Florida, of course, very attractive. Parallel, one of the largest operators in Florida. They also have operations in Massachusetts, which is a more competitive state, but I think they have a very strong story in Brookline. They have Texas. What happened to the Pennsylvania piece? Is that something that you have a right to also in terms of a license, or you're totally out of that?
So the Pennsylvania exposure has been exited. That was a non-competitive position where an exit under a restructure actually increased the free cash flow of the business. So that was a purely economic decision. And really, each of these set of operations has shown up in a very different state. The regulatory environment is part of that. The operating strategy would be another. But as you point out, I mean, Massachusetts is one of the worst regulatory structures of many states, most challenging from a number of standpoints. And as you point out, Florida has been very attractive and generated strong economic profits for a number of top operators there. Right.
And again, you know, and Zach, I realize that, again, I even say you're limited in terms of what you can say, but I mean, some of these U.S. assets could be very valuable, you know, down the line, again, especially Florida, right? But is the idea that you build from that through M&A and becoming a larger MSO? Or is it, you know, to look for an exit at some point and just sell that to other operators? I'm talking about the U.S. operation or the future U.S. operation.
Yeah, so given our structure today, we aren't able to engage in plant touching activities. We have successfully deployed capital into the U.S. markets on a compliant basis, you know, with our NASDAQ listing. So that can continue to happen. Again, we do have a debt-free balance sheet with significant unrestricted cash, and so that's an option. We do get asked this question a lot. The color I can provide to you is that the management teams of those businesses are working hard to improve operations, and there's a lot of low-hanging fruit, some big opportunities. There's no defined exit. We do have the opportunity to continue to grow and potentially, you know, kind of climb the ranks in terms of becoming at some point a more meaningful MSO. But again, getting the work right, serving consumers and building a strong business creates optionality on both fronts. So really the work needs to be focused on improving operations. We are starting to get an increased volume of calls from, you know, potential or would-be suitors or, you know, various M&A candidates that see our balance sheet and liquidity posture and experience as potentially a good source for partnership. But there's just nothing concrete we can speak to today, and would certainly disclose that if something material were in the works.
Right, and in terms of what you've disclosed, obviously it's a ring-fence structure, right? Exchangeable shares. So SNDL itself keeps its NASDAQ listing, but you're able to equitize those loans. That's the way you explained it, correct?
Correct.
Okay, but while we still do not have federal permissibility, and before you're able to fully consolidate those businesses, how are you able to further fund those businesses, or you're in the meantime, or you're not? You're just not able to do that.
Well, a couple of things there. In terms of the specific question on funding, you know, that has already occurred, right? So we've successfully deployed that capital. Mm-hmm. The activity itself, and then the subsequent formation of a structure to hold reorganized equity has been reviewed by NASDAQ. So I believe that not just us, but other of our peers have also demonstrated that there is clearly an ability to deploy capital. Now, do we want to do that? If it's simply nursing cash-consuming businesses, that's not that attractive at the end of the day. It may be attractive if it was for growth purposes or strategic investment, and that's something that we're reviewing on an ongoing basis. But we're confident that should the opportunity arise that is supported, you know, by our leadership teams and board, that we will absolutely be able to execute against it.
All right, understood. And just to be 100% clear on that point, so So I think that that's important for people to understand that if once, as you take control of the parallel operation, specifically in Florida, right? And while we still don't have federal permissibility, if Parallel decides to expand in Florida because of the great opportunity there, with your ring-fence structure, SNDL will still be able to participate or support in that way with fresh new capital, that expansion. Is that true, or am I missing something there?
The only correction I would provide is you use the word control, and so that's sort of a bright line test. So in terms of control, in terms of influence, in terms of voting, reorganized equity, none of that is permissible, right? We cannot have, say, an officer such as myself or a director from SNDL serve on the boards or in the C-suites of these companies. So they are very much independent and required to be so under the framework that's been reviewed and supported by NASDAQ.
Right. Look, and before we move on to the other divisions, so obviously the other loans are current, and there's, I guess, nothing to talk about there. But in the event that something happened with any of those loans, what's your protection, or can you negotiate, swapping the asset for another state, or what? Just in very general terms, can you talk about, your protection, your level of security in terms of our collateral, or what are your options in case that something were to happen with the other three credits? And I'm speaking hypothetically in general, right? Go on, yeah.
It's a great question, and you've got an insightful view, I would say. You can imagine that as some of the U.S. operators have looked to get leaner, improve their profitability, and despite some of the progress they've made, you still have this industry facing a very high cost of capital, really across the board, whether it's equity or credit, and so every scenario that you would envision has been looked at in one form or another. So whether that's exchanging or extinguishing debt in order to receive an asset, whether it's restructuring of multiple credits to improve balance sheet health, push out maturities, reduce cost of capital. That's something that our joint venture has looked at and had thoughtful conversations with borrowers over time. In some cases, we would be well positioned if there was an event of default or an insolvency to reorganize those businesses in a way that would be very attractive. But given the success those businesses are having, that's potentially not a likely scenario, and the return of our capital is likely in those cases.
Right, understood. Look, and just a couple of more on the U.S. And again, it goes, the focus is so much there, right? But so I think the way you explained it just now, all the options are on the table, right? You're equitizing, obviously, the Parallel and the SkyMint loans. What you do in the future, you may add to that portfolio in terms of M&A, or you may look at other, or just status quo, or you may even actually look for an exit. I think you've said that. But in the event that you were looking at building a larger MSO, given the cash that you have right now and the low valuations, would it make sense for you to be doing other types of transactions in the US at the moment, like, say, like, again, hypothetically speaking, like brands, right? You had Canopy do an option deal with Wana and with Jetty. Given your balance sheet, your cash, and where we are in the US cycle, will it make sense for you to be adding through option structure type agreement, other assets to that future US ecosystem? Or that would be too far, that would be like doubling down, and you don't want to do that right now at this point in time?
No, I think that's something that we're actively looking at. The only distinction there is, I would characterize what we're doing as building the critical infrastructure to deliver, THC-oriented products to consumers. So you'd be less likely to see us, engage in some splashy transaction, paying a double-digit revenue multiple for some brand that we think is going to, go national and be massive, and much more likely to invest in automation, in retail expansion, and distribution infrastructure that can improve profitability.
Right. Understood. Look, and here I'm not going to ask you to speak on for investors, right? But it just seems to me the way that these stocks are behaving, that right now retail investors are giving more credit to Canopy Growth for the US ecosystem than to SNDL. But your ecosystem, it's quite attractive, right? I don't know if you want to make any comments there in general.
Well, I'll take that as a compliment, and appreciate the comment. But I think the key sort of phrase there is retail, the notion that retail investors are giving credit. I'm not actually sure that's the case. Some of these massive days that you've seen in terms of trading volumes, and I'll just look at Canopy. The real question is what % of that is actually just all high frequency and algorithmic based trading.
Right.
So some of these valuations, like I think we can agree that over periods of time, markets can actually be highly inefficient. I think that would be the case in this sector. And there are a lot of sort of crosswinds at play when it comes to the technical dynamics that drive security pricing. Right.
Okay, understood. Look, and then just briefly on the other divisions, and again, I want to make sure I understood exactly what you said. You said the biggest opportunities in the portfolio right now are Sunstream, the US operations, right? Eventually, the cannabis retail piece, and then I think you played down the liquor retail piece and the cannabis operations themselves, but maybe I misunderstood.
Look, I wouldn't say downplay. We're in the midst of a very important turnaround in our upstream business in cannabis in Canada. I've been calling for a trough in the Canadian market for the last 2 quarters. We're starting to see sort of all grades of biomass start to trade up a bit in Canada. I think we've seen the worst. And so whether it's export volumes, increased consumption, more disciplined cultivation practices, and then also, of course, the recent garnishment of excise by the CRA through the provincial boards. Yep. All these factors are helping to, I think, put a bottom in that market. And so our cannabis operations segment, for the very first time since inception, put up positive, both positive gross margins and operating income. And we have, our goals are a far cry from where we are today. So that I don't want to downplay. It's a critical part of the improvements that we expect to generate in the coming quarters. And we've also driven massive improvement in the liquor segment. We're seeing margins today that have never been experienced in the history of that enterprise and that management team. So getting a few things right, working on aggressively managing working capital, and a number of other items that have improved results. And we're certainly not done yet. We're also in the middle of the last several months. Our management team, our executive leadership team, has been hard at work refreshing a strategic plan that we intend to present to our board in June. And we're still looking for ways to unlock value. And so there are really no sacred cows here. And as I think you've asked in the past, in terms of potential spin-offs or sales, really anything's on the table. And we're looking at a number of options to unlock value for shareholders.
Understood. And then just if you can expand on the cannabis retail piece, right? I think Value Buds just entered British Columbia, very competitive sector, but ripe for consolidation. So probably a lot of opportunities there. Just remind us why you are excited about that segment of that part of your business portfolio, and what are the plans there for cannabis retail? Thank you.
Great. So I think you're very familiar, Pablo, but maybe some of the US-based audience is not. But in Canada, at this moment in time, when you look at the complete supply chain, the best economics on average are being earned by downstream operators in retail that have scaled portfolios. And so you've seen in the cases of a Nova or a High Tide that they've already posted positive EPS and free cash flow. The licensed producer set to date has largely been a zero economic exercise. And that is changing, and I think it'll change quite rapidly over the next 12 months. But there's a lot of catch up to do there. So it's an attractive place to be when you combine when you really look at this in a market where the only way in a legal framework that the consumer can access THC products is through these retail licenses, it really becomes an important choke point. And you combine that with the complete lack of marketing access that our brands have in Canada, it's even more critical to where this will change over time. But to date, even branded product has become largely commoditized. And in some sense, the retail banner itself, gets more exposure than anything. So the dominant themes in that landscape in retail have been really convenience and value, which is why the early sort of discount retailers were able to be so disruptive, running lower margins, driving higher volumes on small footprint stores. And of course, this will evolve over time. But if you want to own the consumer relationship, you really have to do it at retail in the Canadian context.
Right, and just staying there, in terms of what you had disclosed in the past, right? The plan was to acquire fully Nova, right, and then later spin off, I believe, the retail piece to your investors. That changed because the Nova deal did not go through. So how are you thinking about that going forward now? Or is the Nova deal still on the table down the road?
It's a great question. We don't have a definitive answer for that. We're looking at options today. We've supported Nova with capital. The management team there has done a great job. We were able to successfully help that portfolio to grow to 100 doors with more to come. And what's really been interesting is the impact that our Canadian credit portfolio has had on that business. I think now we've been involved in 4 different CCAA processes where we've pulled licenses out of bankruptcy and then been able to add them to our network. And that would have been the case for this recent transaction in BC. The issue in BC is that you're capped to a maximum license holding of 8. So quite difficult to gain scale in that marketplace. But we believe that those regs will likely change by the end of 2025, where that cap will get increased.
Understood. Look, I know we're going to be running out of time here, but just on the last question on the SunStream USA structure, just a reminder for the audience here in terms of what are the next steps. And I understand that the timing of the timetable is not exact, but just in general terms, right? The restructuring has to be completed. Just big picture, Zach, if you can, just very big picture.
Sure. Yeah, so as we've stated, we're now working to close these restructurings. Having the NASDAQ review completed was a really important step. We need the license transfers to occur and a smattering of other closing conditions to be met in order to close. But as it stands today, we expect both Skymint and Parallel to close later in the 2024 calendar year. And these restructurings have taken an enormous amount of time. And yes, we've had litigation and other challenges along the way. Parallel specifically, you'd be challenged to invent a more complex capital structure than that was put together, in this situation. Mm-hmm. And as I try to remind people, if these businesses, which are still federally illegal, could avail themselves of the federal bankruptcy court regime, these restructurings could have likely been wrapped up in 3 to 5 months. In the case of Parallel, it's been over 2 years and we're still not done.
Right.
So, are we blazing trail to some extent? Yes. But the legal costs and the brain damage involved in getting even to where we are today has been nothing short of brutal. And the good news is that we can see the light at the end of the tunnel now.
Right. Thank you. Look, and again, I'm not going to get into the subject of litigation, but in terms of what's public information, I think the market report talked about a settlement in Florida with Knight. Was SNDL involved in that, or that's totally separate? Again, if you can answer only. But
I'm sorry, a settlement in Florida with.
I believe the market report talked about some settlement between various parties around Parallel in Florida. But okay, you're not familiar with that, so it's fine. I'm not gonna delve into that in detail. But there was some report of I'm trying. I thought I had it in front of me here, but in terms of their two parties agreeing on something. I'm gonna find it here, but I'm gonna. Yeah, I'm sorry. Okay.
So you know what I would say here, Pablo, just to maybe disarm the question a little bit. As I mentioned at the beginning of the call, I walked into a situation that had multiple class actions, resolved them. There hasn't been a moment in time over the last 4 years when we haven't faced some litigious challenge from some party. When you're dealing with restructurings, reorganizations, when you're dealing with an industry that's gone through and is still going through as much stress as cannabis is, the way we refer to this is that it really is full contact capitalism, and so this stuff is all expected. It's par for the course, and we continue to work through it and have been successful in doing so.
Yeah, thank you. Look, I mean, again, I know we're running out of time. I want to just read you brief questions from the audience here, but just brief answers. How do you plan to become top 5 in cannabis in Canada? How do you achieve that, and where are you right now? Just quick answers.
It's a great question. Clearly, we need to improve the distribution of our branded product mix, as well as becoming, while we're already a trusted B2B partner for many of the top LPs, we'd like to grow that business as well. And additionally, increase the scale of our retail network, and that will be a big driver for reaching goals to become a member of what we think in the future will be an oligopoly in Canada.
Right. In terms of international, what are the plans there, and are you too late?
Are we too late? That's a great question. I don't think so. As would be the case for most things in CPG, kind of better usually beats first. There are still a number of markets that are in very, very early phases of development. What's really interesting, from a Canadian lens, is that when you look at a new market like Germany, the majority of the flower that you'll find in Germany is actually Canadian today. So Canada has been a very interesting export partner, and when you look at the volume of sort of distressed sales of biomass and flower, and the amount of flower that's sold below the marginal cost of production, that pain really accrues to the benefit of nations that are looking for reliable, regulated supply, and I think that those channels will get even more interesting over time. So we are looking at select opportunities, but as I think you've helped point out through this questioning, we do have a lot on our plate, and winning in North America is key for us.
Okay. Look, I'm reading here brief questions, just brief answers. Someone asking on the 25% stake in Pathway RX.
Immaterial.
Immaterial. Okay. And how are you pleased with the performance at Valance since the acquisition, or versus your expectations or challenges you faced since the deal?
So we've certainly encountered challenges. We've got great leadership with Tyler Robson as our president of that segment. Really, Valance was all about capability. They did not have a demonstrated track record of long-term profitability by any stretch, but this was an opportunity for us to move away from non-competitive, high-cost grow and lean into a team that had demonstrated great capabilities when it comes to all material product segments in cannabis, but also had a very aggressive procurement strategy. And when you look at our Q1 results, in my opinion, it really validates the strategy to pursue and acquire Valance, because we're seeing the benefit of it today, and I believe that's going to grow materially over time.
Right. And someone is asking whether does Valance, is it going to play in drinks, in cannabis drinks? Is that part of the strategy? I mean, just a short answer on that.
Today we have material market share in the Canadian beverage market. The issue is that volumes are low. It's a very small subset of the market, and product prices are too high and need to come down with increasing volumes.
Right. And the last one, in terms of the proprietary data licensing business you have, that's standard for the retailers in Canada, right? High Tide also sells data, Fika and Fire and Flower also sell data, or is there something unique about that model in your retail cannabis business?
A few minor unique elements, but you are absolutely correct that is standard practice and an offering that most of the best retailers offer to their licensed producer relationships.
Right. Okay. So look, I very much appreciate your time here. Apologies to everyone and to you, Zach, especially, of course, because of the technical issue we had midway through there. Closing remarks, maybe just a reminder of why people should be looking at the stock, the valuation upside. And I guess I hope I'm phrasing this question properly. You know, to someone that's never heard about SNDL and suddenly see it in the company of AMC and GameStop as meme stocks, you know, what would you tell to those people that I guess it's good that they are learning about SNDL, but maybe they should do the research first and understand that there's a lot more to the story, right? But than just a meme stock. But closing remarks, and if you can touch on some of those things there, Zach, and thank you again.
Yeah, first of all, thank you, Pablo, for setting this up. I guess we made it through even with the slight disruption. And surprise, surprise,
Yeah.
you know, X has issues as well. But look, what would I say? This is not a company based on hype, right? We have real fundamentals. We're a real business. We're doing what we said we were going to do. We have an enormous opportunity. We have a valuation that's not demanding. Do your diligence, do your research, understand the space, understand these companies, understand our platform. That would be my advice.
Yeah, no, thank you very much. Again, thanks everyone for joining, and we will put the recording of, I guess, chapter 1 and chapter 2 of this call on Twitter and online. And again, thank you, Zach. Everyone, have a good day.
Thanks, Pablo.